The signal everyone's missing in silver is not the price movement you're watching on your screen right now. It's something far more dangerous, something happening beneath the surface that most small investors have no idea is even occurring. While you're focused on whether silver goes up or down by a few dollars, the entire structural foundation of this market is shifting in ways that could trap unprepared investors on the wrong side of history. What I'm about to show you isn't speculation. These are documented flows, institutional behaviors, and supply constraints that are creating a scenario most people in silver have never witnessed before. The gap between physical silver and paper contracts has reached levels that historically precede major market disruptions. And the warning signs are everywhere if you know where to look. Over the past 18 months, something unprecedented has been happening in silver markets. Large institutional buyers have been accumulating physical metal, while simultaneously the futures market has seen contract concentrations reach extreme levels. This isn't normal market behavior. This is positioning for something specific, something that most retail investors are completely unprepared for. The data tells a story that most market participants are choosing to ignore. In the past 12 months alone, silver exchange traded fund holdings have increased by approximately 47 million ounces. To put that in perspective, that represents roughly 6% of total annual mine production being locked away in institutional vaults. But the concerning part isn't just the quantity, it's the velocity at which this accumulation is occurring, and the identity of the buyers making these moves. The first thing you need to understand is that the silver market operates on two distinct levels. There's the paper market, where most price discovery occurs through futures contracts, derivatives, and exchange-traded funds. Then there's the physical market, where actual silver changes hands, gets stored, gets consumed by industry, gets held by investors who want to touch what they own. For decades, these two markets moved in relative harmony. Paper prices reflected physical availability reasonably well. Supply and demand found equilibrium through normal market mechanisms. But that relationship has been deteriorating steadily. And in 2026, the disconnect has reached concerning proportions. Consider the current supply situation. Global silver mine production peaked several years ago and has been declining despite higher prices. This isn't unusual for commodities, but silver faces unique constraints. Unlike gold, which gets hoarded and recycled extensively, silver gets consumed. Industrial applications destroy silver permanently. Electronics, solar panels, medical devices, antimicrobial coatings, these uses remove silver from circulation forever. The numbers paint a stark picture. According to the Silver Institute's latest data, industrial demand consumed approximately 540 million ounces in 2025, representing nearly 70% of total annual mine production. Solar photovoltaic applications alone accounted for 135 million ounces, a 22% increase from the previous year. This growth isn't slowing down. As governments worldwide push renewable energy mandates and solar installation targets, industrial consumption continues accelerating at rates that mining production cannot match. But there's another layer of industrial demand that rarely gets discussed. The defense sector's silver consumption has been growing quietly but substantially. Advanced military electronics, radar systems, missile guidance technology, and electromagnetic warfare equipment all require significant amounts of silver. Unlike consumer electronics, where companies might substitute other materials if prices become prohibitive, defense applications prioritize performance over cost. Military contractors pay whatever price is necessary to secure the silver they need for national security projects. Meanwhile, industrial demand continues accelerating. The transition toward renewable energy systems requires massive amounts of silver for photovoltaic applications. Electric vehicle infrastructure, smart grid technology, 5G networks, all of these technological shifts are silver intensive. But here's what most analysts miss. This demand is inelastic. When Apple needs silver for iPhone production, they don't cancel the iPhone because silver prices doubled. They pay whatever the market demands. The automotive sector presents another angle that's often overlooked. Electric vehicles require approximately 3 times more silver than traditional internal combustion vehicles. Every EV contains silver in its batteries, electric motors, charging systems, and electronic control units. As governments implement combustion engine phase-out policies and consumers shift toward electric mobility, automotive silver consumption is projected to increase by over 40% within the next 5 years. The supply response has been sluggish at best. New mine development takes years, requires massive capital investment, and faces increasingly strict environmental regulations. Recycling provides some supply, but recycled silver from electronics requires expensive processing, and yields are limited. The mathematics are becoming impossible to ignore. Industrial consumption alone now exceeds new mine production in most years. What makes this supply constraint even more critical is the geographic concentration of production. Roughly 60% of global silver mine production comes from just 5 countries: Mexico, China, Peru, Chile, and Bolivia. Any geopolitical disruption, labor strike, Environmental disaster or policy change in these regions can immediately impact global supply. This concentration risk has become more pronounced as mining companies focus on their most profitable operations and abandon marginal projects. The situation in Peru illustrates this vulnerability perfectly. Political instability and community opposition to mining projects has led to production delays and uncertainty around expansion plans. Several major silver mines have faced temporary shutdowns due to protests and regulatory challenges. When you consider that Peru supplies roughly 13% of global silver production, these disruptions have immediate market implications. Against this backdrop of tightening physical supply, something unusual has been occurring in the futures markets. Open interest, the number of outstanding contracts, has reached historically elevated levels. But here's where it gets interesting. The commercial traders, the miners, and industrial users who typically hedge their exposure have been reducing their net short positions significantly. This shift suggests that commercial participants, the people who actually deal with physical silver in their businesses, are becoming less willing to sell forward contracts at current prices. When companies that mine silver or use silver in manufacturing become reluctant to lock in current prices for future delivery, that sends a signal about their expectations for supply availability. The most revealing indicator comes from examining the commitment of traders reports published weekly by the Commodity Futures Trading Commission. Over the past 6 months, commercial traders have reduced their net short positions by over 30%, while simultaneously, large speculators have increased their long positions by nearly 25%. This positioning represents the largest divergence between commercial and speculative positioning in over a decade. Simultaneously, the large speculators, the hedge funds and commodity trading advisors, have been building long positions. This isn't necessarily bullish by itself. Speculators are often wrong. But the timing and magnitude of these positions, coinciding with commercial trader behavior, creates an unusual dynamic. What's particularly significant is the identity of some of these large speculative buyers. Several sovereign wealth funds and pension systems have begun allocating portions of their portfolios to physical precious metals as currency hedge positions. The Norwegian government pension fund, managing over $1 trillion in assets, has increased its exposure to precious metals mining companies by 40% over the past year. Similar moves have been documented from Canadian pension plans and Australian superannuation funds. The real concern emerges when you examine exchange-traded fund holdings. Several major silver ETFs have seen substantial inflows over the past year. These funds must purchase physical silver to back their shares. As more money flows into these vehicles, more physical metal gets locked away in vaults, removed from the available supply that could satisfy industrial demand or private investment demand. The SLV ETF alone holds over 650 million ounces of physical silver, representing nearly 10% of all above-ground silver stocks. But the critical detail is how quickly these holdings have been growing. Monthly inflows into precious metals, ETFs, have averaged over $2 billion throughout 2025, with silver funds receiving a disproportionate share compared to their historical allocation percentages. Now, layer in the central bank policies that have kept interest rates elevated while simultaneously maintaining massive balance sheets. Higher interest rates make holding non-yielding assets like silver more costly. But continued monetary expansion and currency debasement concerns are driving investors toward hard assets as portfolio protection. These conflicting forces create volatility and uncertainty that favor those who understand the underlying dynamics. The Federal Reserve's current position exemplifies this contradiction. Despite maintaining interest rates in restrictive territory, their balance sheet remains over $7 trillion, nearly 10 times larger than pre-2008 levels. European Central Bank and Bank of Japan policies show similar patterns. This creates an environment where traditional bonds face inflation risk while cash faces debasement risk, pushing investors toward alternative stores of value. The institutional buyers who have been accumulating physical silver aren't retail investors making emotional decisions. These are pension funds, sovereign wealth funds, and family offices with billion-dollar portfolios. They have research teams, they study supply fundamentals, they plan moves years in advance. When these institutions begin accumulating a physical commodity systematically, they typically see something in the supply-demand equation that hasn't been fully recognized by markets yet. Recent SEC filings reveal that several major hedge funds have established significant positions in silver mining companies and physical silver holdings. Bridgewater Associates, Ray Dalio's firm managing over $150 billion, has increased its precious metals allocation by 60%. Similar moves have been documented from Tudor Investment Corporation and Soros Fund Management. These aren't momentum trades or speculative bets. These are strategic asset allocation decisions based on macroeconomic analysis. But there's another layer that most people don't consider. The silver market is relatively small compared to other commodities. Total annual mine production is worth roughly $12 billion at current prices. For context, That's less than the market capitalization of many individual stocks. A few large institutional buyers moving into physical silver simultaneously could absorb available supply quickly, creating price pressures that cascade through both physical and paper markets. To understand how constrained this market really is, consider that the entire global silver market represents less than 1% of global bond markets and roughly 2% of global stock markets. When institutional money begins rotating out of traditional assets toward commodities for portfolio diversification or inflation protection, even small allocation percentages create enormous demand relative to available supply. The inventory data supports this concern. COMEX warehouse stocks, the silver held at exchanges that backs futures contracts, have been declining steadily. Current registered stocks stand at approximately 68 million ounces, down nearly 30% from peak levels reached in 2020. London Bullion Market Association vaults, which store silver for institutional investors and ETFs, show significant movements, but lack transparency about whether metal is moving into strong hands or just being repositioned. What makes this inventory decline particularly concerning is the relationship between registered and eligible stocks. Registered silver can be immediately delivered against futures contracts, while eligible silver is held in vaults, but not immediately available for delivery. The ratio between these categories has been deteriorating, meaning less silver is readily available to satisfy potential delivery demands from futures contract holders. What's particularly interesting is the behavior of smaller private investors during this period. Retail silver purchases from coin dealers and precious metals companies remain elevated, but not at panic levels. This suggests that the institutional accumulation is happening without creating public awareness yet. Professional investors are positioning quietly while retail sentiment remains relatively calm. Sales data from major precious metals dealers indicates steady demand for physical silver products, but without the urgency or premiums that typically accompany retail buying frenzies. American Silver Eagle sales from the U.S. Mint have been consistent but not exceptional. This measured retail demand combined with aggressive institutional accumulation creates a unique dynamic where supply is being absorbed without creating obvious market signals. The supply side pressures that most investors are ignoring could create sharp price movements because silver supply chains are inflexible in the short term. If industrial demand continues growing while mine production stagnates and investment demand increases, the only variable that can adjust quickly is price. And when prices need to adjust in commodity markets with inelastic supply and demand, the movements tend to be dramatic rather than gradual. Consider what happened in palladium markets several years ago. Automotive demand for catalytic converters remained steady while mine supply from Russia faced geopolitical disruptions. Investment demand remained minimal because palladium lacks the monetary history of gold and silver. But even with limited investment interest, palladium prices more than doubled in 18 months purely due to industrial supply-demand imbalances. The palladium example demonstrates how quickly commodity markets can adjust when supply and demand fundamentals become imbalanced. Silver faces similar supply constraints, but with the added complexity of significant investment demand. Unlike palladium, silver has a monetary history spanning thousands of years. During periods of currency instability or inflation concerns, silver attracts investment flows that can dwarf industrial demand. If supply constraints coincide with increased investment demand, the price adjustments could be severe. Historical precedents suggest these adjustments happen faster than most participants expect. During the 1979 to 1980 silver rally, prices increased from $6 to over $40 per ounce in less than 18 months. While that particular episode involved market manipulation that distorted normal dynamics, it demonstrated how quickly silver markets can move when supply becomes constrained and investment demand accelerates. The timing of these dynamics aligns with broader macroeconomic conditions that favor hard asset preservation. Government debt levels across developed nations have reached peacetime records. Central bank balance sheets, despite recent reduction attempts, remain historically elevated. Currency debasement through continued money printing creates long-term purchasing power concerns that drive investors toward tangible assets. Current fiscal trajectories in major economies suggest these monetary conditions will persist regardless of political changes or policy rhetoric. The United States federal debt continues growing by over $2 trillion annually, while interest expense on existing debt consumes increasingly large portions of tax revenue. European nations face similar debt dynamics, complicated by demographic challenges and energy transition costs. These structural fiscal imbalances make continued monetary accommodation necessary, even as central banks express concerns about inflation. But here's where small investors need to think differently than institutions. Large buyers can influence markets through their purchasing power. They can negotiate better prices, secure supply directly from miners, access wholesale markets that retail investors cannot reach. Small investors must understand that they're operating in a different environment with different rules and different risks. Institutional buyers often negotiate long-term supply agreements directly with mining companies. bypassing spot markets entirely. They can commit to purchasing future production at fixed prices, providing miners with financing and price certainty while securing guaranteed silver delivery. Retail investors lack this access and must purchase silver at whatever prices spot markets determine when they are ready to buy. The paper market provides liquidity and price discovery, but it also creates leverage and complexity that can work against unprepared investors. Futures contracts require margin, have expiration dates, can face delivery obligations. ETFs hold physical silver but charge management fees and can trade at premiums or discounts to their underlying metal value. Leveraged products amplify both gains and losses in ways that can destroy accounts quickly. Understanding these market mechanisms becomes critical when supply-demand imbalances create volatile conditions. During periods of market stress, bid-ask spreads widen, liquidity diminishes, and price discovery becomes less efficient. Investors who don't understand these dynamics often make emotional decisions at exactly the wrong times, buying at peaks and selling at bottoms. Physical silver ownership eliminates counterparty risk, but creates storage, insurance, and liquidity concerns. Buying physical silver at retail prices often means paying premiums above spot prices. Selling physical silver may require accepting discounts below spot prices. These spreads represent real costs that must be factored into any investment decision. The key insight for small investors isn't about timing markets or predicting price movements. It's about understanding the structural changes occurring and positioning appropriately for your specific situation. If supply-demand fundamentals are tightening, that creates both opportunities and risks depending on how you're positioned. Those who understand these dynamics can make informed decisions about whether physical ownership makes sense for their portfolio, whether they want exposure through ETFs or mining stocks, whether they should dollar cost average over time or make lump sum purchases. The important thing is making conscious decisions based on actual market structure rather than reacting emotionally to daily price movements. The institutional buyers accumulating silver aren't panicking about short-term price volatility. They're positioning for longer-term structural changes in supply, availability, and monetary conditions. Small investors who want to participate in this trend need similar patience and discipline. Markets can remain disconnected from fundamentals longer than most people expect, but eventually, supply and demand physics assert themselves. What's happening in silver markets right now isn't just another bull market cycle or speculative bubble. It's a structural shift in the relationship between paper claims and physical availability. Those who recognize this shift early and position appropriately may benefit significantly. Those who ignore the underlying dynamics and focus only on price movements may find themselves unprepared for what's coming next. The signal isn't the noise of daily trading or headlines about price targets. The signal is the quiet accumulation by informed buyers, the tightening supply metrics, the growing disconnect between futures markets and physical availability. Understanding this signal matters more than predicting exact price levels or timing market moves perfectly. The question isn't whether these dynamics will eventually impact prices. The question is whether you'll be prepared when they do.